Wheat prices plus 14%. Cotton prices plus 15%, soybean prices plus 17%, aluminum plus 29%. Yes, the price of oil is up 70% over the last few months, but most investors are missing what's really happening underneath the surface. The prices of almost every single raw material that we require in order to build and power our modern economy has jumped considerably over the course of the last few months. In fact, if we combine all of the key raw materials into a single index, the commodity price index, we get a chart that looks like this. It has risen by approximately 30% over the course of the last 6 months, reaching the highest level since 2022, which was the height of the Russian oil shock from the invasion of Ukraine. You see, the reason following the price of these raw materials is so important is because the rate of inflation for the US consumer, what's known as the consumer price index, is extremely tied to what these are doing. And it's currently telling us that we're going through a paradigm shift that is going to ripple through the stock market, the economy, and most importantly, ordinary people in a massive way. Whenever inflation picks up, it has actually created some of the most incredible investment opportunities in recent financial history. It is our mission to keep you informed on these kinds of major shifts because it's at these moments where the gap between investors who make catastrophic mistakes and those who make millions can widen very quickly. So please like this video, subscribe to the channel, and share this out to people who you think will find it valuable. This does so much to help the work that we do here on YouTube get pushed out to new people. Many economists have already drawn the comparison between the 1970s inflation waves and the patterns of inflation that we are seeing today, and indeed the similarities between the two episodes are uncanny. Now, with the price of basic commodities that are surging, this chart is quickly going to look more and more like we are in exactly the same spot as 1972. And we do have many of the same signs that we had back then. For example, the price of gold was surging in the months leading up to the pickup in inflation. This is precisely what we've seen today, with gold tripling in price over the last few years. And this is already showing us that this is a problem that has deeper roots than just an oil shock. Because when we overlay our commodity index on top of gold, we actually see that these tend to follow a very similar path. Things like the price of copper, the price of oil, the price of wheat, that all sound very different from one another, are actually very closely connected to one another. And once they are mashed up together in a single index, we see that they essentially track the price of gold. And that's simply because gold is an anchor to the price of everything in our economy. When gold rises, it effectively tells us that investors have lost confidence in the ability for the US dollar to act as a storehold of wealth, that the US dollar has effectively been debased. And this is why we do not believe that this is just a one-off event, and why the consequences of the energy shock are much deeper than what many realize. Remember, the price of gold has tripled over the course of the last few years. This is the largest and most rapid price appreciation since the 1970s. Excessive government spending, loose monetary policy, the breakdown of the international monetary order, all of these have contributed to the loss of confidence in the US dollar as a currency, which theoretically should drag the prices of everything across the economy higher. Of course, there are moments where an individual commodity can lag behind the price of gold because there is an abundance of that commodity, or there are moments where it will rise much more aggressively than gold when there are concerns regarding the supply of that particular commodity. But over the long term, commodities will be fixed to the price of gold. In the last few years, we see that a gap has been building between the price of gold and the prices of key commodities. The primary reason for this is that until now, there has been very little concern regarding the supply of these commodities, which has managed to keep their prices low despite an ongoing debasement of the US dollar. This was the case for oil as well, that is historically also tied to the price of gold, but in the last few years has diverged away from it. This created one of the largest gaps between energy prices and gold prices in history. But now everything is changing. The war in Iran marks a real turning point in this story that is about to lead to a frenzy across the commodities market. It is of course disrupting the supply of oil that is an input for almost everything in our economy through the manufacturing of goods, transportation of people and goods, and heating. But it's also impacting our food supply, making fertilizers more expensive, making the powering of farming equipment more expensive. The transportation of food is more expensive. The reason for why the prices of oil, wheat, copper, and soybeans are all related is because they are all interconnected from an economic standpoint, while also being connected by the US dollar, because each of these are priced in US dollars. So when you have the combination of the underlying fiat currency losing its purchasing power like it is today, and increased concerns regarding the scarcity of the actual raw materials, history shows that can lead to a rapid repricing of everything in the economy. That is indeed exactly the same setup as we had in 1972. And today in 2026, we believe the story is only just starting out because there are many parts of the commodity market that still have massive gaps that need to be closed with gold. In fact, the part that still has the largest gap is agricultural commodities, or in other words, our food supply. We can see that with the gap between gold and the price of wheat. You can see the same gap with the price of corn, and also the same gap with soybean prices. The agricultural sector has been deeply underinvested over the last 10 years because of low prices. We believe this has led to a structural shortage of crops that is going to lead to the closing of the gaps that we mentioned earlier. So energy prices are moving up and food prices are moving up. These already make a big chunk of the consumer price index, and just these can cause inflation to be materially higher in the next few months. But these will also have an indirect impact on the rest of the components of the CPI, as food and energy are base inputs for everything else we have in the economy. So yes, we do think that we are following the footsteps of the 1970s as commodities are once again accelerating higher. Now, inflation is no longer calculated in exactly the same way as it was back then, and we're also not dealing with the exact same situation, so it's unlikely that we'll follow the exact same path as we did back then. But we do think that inflation is about to jump up considerably to possibly to 4 or 5% in the coming months. And we believe this is leading us to one of the biggest investment opportunities of a decade. Historically, whenever inflation jumps like it is today, we see the stock market dip. This happened in 2022, 2011, 2008, 2001, 1987, 1983, 1974. Each and every single one of these stock market corrections was preceded by some kind of a jump in inflation, just like we are experiencing today. In some cases, the impact on the stock market is immediate. In some, it takes a few months, but it does generally raise the probability of a larger correction substantially. The stock market has been extremely resilient so far, and this could continue for the next few months, but history shows that when inflation turns up like it is today, it eventually leads to a sizable correction within the next 6 to 12 months. Now, most investors panic in these instances, often selling their stocks at the worst possible moment instead of taking advantage of these situations. Yes, higher costs for raw materials like energy, base metals, and food instantly raises the cost of production and transportation for companies, which squeezes their margins of profit. It also squeezes the consumer by directly raising the cost of living and reducing their potential spending power on goods and services. All of this increases the probability of a recession, and so with that, the downside risk on the stock market, which history shows us is a very real risk. But this is a very zoomed in short-term dynamic. If you're a long-term investor, this is not the impact that you should be focusing on. As the stock market is priced in US dollar terms, over the long term, currency debasement is the very reason for why stocks actually eventually always move higher. As the purchasing power of the US dollar steadily declines over time, the stock market is bound to consistently recover to new all-time highs. This is why stocks only go up, because they are priced in US dollars. The real phrase should be the US dollar's purchasing power always goes down. So even if in the short term the stock market does dip as a result of higher levels of inflation, these moments are actually exceptional buying opportunities for investors with a long-term investment horizon. Buying stock market dips during inflation spikes has provided some of the most incredible opportunities in recent financial history and made investors that had a longer-term investment horizon in these periods very wealthy as a result. That was certainly the case for all of the major dips that we discussed earlier. These were all exceptional opportunities to buy the stock market. Now, the only problem with this is that it does take you through a roller coaster. There can be multiple years where you'll be in the red despite continuing to buy the dip, which is something that many investors are not able to stomach, and why so few actually do it successfully. It's possible that stocks can drop 30, 40, or even 50% as a result of this, only long-term investors who are willing to endure that kind of pain will be able to come out wealthier on the other side. There is a way to invest in a more active manner and smoothen out your returns during these types of periods by being exposed to stocks that can actually continue to grow their earnings and expand their profits in this kind of environment. These are stocks that not only benefit from higher inflation in the short term, but they also benefit from the longer term effects of currency debasement that we mentioned earlier. That means these stocks have the potential to see truly spectacular returns. The agricultural ETF is already up about 20% over the last few months during a period where the S&P 500 corrected by 10%. We actually expect this to intensify in the coming weeks and months and easily lead to another 30 or 40% jump in the agricultural ETF. If we're right about this, some of the individual stocks within this index could 5x or even 10x. So while most investors are panicking during this period of geopolitical uncertainty, there are parts of the market where the risk reward is so asymmetrical that it doesn't even matter what happens with the war because you're going to come out on top no matter what. We've been able to pull this off with multiple big bets that we've recommended on our macro strategy membership, like our position on the commodity fund that has risen massively since the start of the war, or our position on aluminum that is also up double digits since the start of the energy shock. There are many opportunities like this that we are looking at that we expect to actually thrive in the current economic context, but agricultural stocks are the investment opportunity that is probably at the very top of our list right now. Take this stock that we call our grain choke point play. It's already up 100% just over the last few months. This is one of the dominant players in the global grain market, but if you zoom out to the prior commodities bull market from the early 2000s, this is a company that went up by 15-fold over the course of just a few years, and it's now only just breaking out of a decade-long base. We believe it has the ability to at least triple in price from here in the current agricultural bull market. If you're able to position in strong companies in a sector that benefits from the macro environment, you can continue compounding your portfolio regardless of a market drawdown or a recession. We have multiple other stocks in the agricultural sector just like this one that we believe are due for some crazy returns in the coming months. Because these are opportunities that need to be taken advantage of right now, we have put together a very special invitation for you to join our macro strategy membership in the link down below. Instead of needing to pay the usual $1,800 that most of our clients pay to access all of our research, we're providing the very same full access to our complete macro strategy for just $3.99 for your first 90 days. This is a deal that will only be available for the next few days because it is a steep discount compared to the price that most of our clients pay. As a member, you'll receive immediate access to every asymmetric investment opportunity that we've identified in the agricultural sector, both our current positions and the ones that we'll be adding soon. But you'll also have access to our entire complete macro strategy, which includes our actively managed portfolio of all of the other top investments that we are currently exposed to and the investments that we think can thrive in the current geopolitical context. You'll be receiving access to all of our current positions in the agricultural sector, along with real-time alerts for any position that we add, along with the specific weights that we are allocating to each position. You'll also be receiving alerts for all of the other opportunities that we see in the market during this period of turmoil for the next 90 days. For context, our lead portfolio strategist has averaged over 50% annual returns over the last 5 years, so by joining the membership using the link below, not only are you going to see the biggest investment opportunities of 2026, but also joining a professionally managed investment strategy. For the next few days, we're also providing a full 100% money back guarantee for your first month on the service, so you can get access to all of our agricultural stocks that are on the brink of melt-ups, see our entire portfolio, all of our investment ideas and research, and if you're not satisfied, we'll refund every penny, no questions asked. The reason we're doing this deal is that we want as many of you to be able to access these opportunities, but most importantly, not waste time, because these stocks are moving day after day, and they could see an explosive move higher at any moment. Whether you capture this depends on what you do right now. This is an opportunity we've been talking about for months, but with crop prices that are beginning to move, this is only going to accelerate from here. That's why I urge you to join our strategy right now by clicking on the link below and stake your claim in these incredible agricultural stocks along with our entire investment strategy. Thank you for watching.